All right. Good morning, everyone, and welcome to ConsistentOptionsIncome.com webinar. Today we're going to talk about pairs trading and how you can use it for more consistent profits with a lot less risk than a lot of other trading strategies that you might employ. So let's get started. All right, the agenda today is going to be I'm first going to cover a little bit of an overview of what pairs trading is, about the pairs trading course, and then specifically about pairs trading. I know pairs trading is probably new to many of you. And then also we're going to get into why trade pairs, right? What are the advantages? And we'll talk a little bit about risk management, and then we'll talk about the pairs trading service, brokers and commissions, how important those are, and then we'll have a Q&A session. So as you're going along, go ahead and type in any questions you might have into the chat window, and I'll cover all of the questions at the end of the webinar. Okay, about the pairs trading course. Even though my website's called Consistent Options Income, the pairs trading strategy does not involve options. We're strictly trading stocks. Originally I had the options course available, and over the years, just talking with people, as I mentioned, that I was also trading pairs, people had a lot of interest in it, and it fulfilled a certain aspect of my portfolio. So I've been kind of working over time to try and put together a course to teach other people how to do pairs trading. So the main difference is that the options strategy that I teach in the options course is more about income, whereas pairs trading is a way for me to put a lot of capital that otherwise might be idle to work, sort of building wealth. We're not going to hit any home runs with pairs trading, but because it's a very safe way to trade, we can put a lot of capital to work and build wealth over time. We wouldn't really want to use pairs trading to create an income. It's not as the equity curve is probably a little bit more volatile. So the options trade's a way to create an income that we want to spend month after month. Everything's built around making it very consistent. Whereas a pairs trading is just a way to participate in the market, very low risk, put a lot of money to work, and build wealth over time. So on my website, I've published the pairs trading course. All the videos are available for free. So if you sign up for the free videos on my website, you'll basically have access to all of the videos in the pairs trading course. And it will teach you everything that you need to know to trade pairs on your own. In fact, I have a free indicator. If you sign up for my pairs trading service, you could actually cancel the service at some point and still use the indicator to help you in your own pairs trading. I think what you'll find, though, is that a lot of work and time goes into sort of curating your pairs. In other words, what pairs do I want to trade? And also finding the opportunities. Okay, I want to trade these pairs, so when's a good time to open a pair? Or when should I close my pair? That sort of thing. So there's a lot of effort that goes into that. And if I had just published the pairs trading course, and charged for the course, I think at the end of the course, people, most people would go, this is really a lot, way too much work for me. So the solution to that is I created the pairs trading service, and basically I curate the pairs, which is quite a big workload. I've automated a lot of it, and I've also automated the signals for when to open pairs and when to close those pairs. So hopefully, my hope is that you'll want to outsource the sort of drudgery work of curating and monitoring the pairs, and use my service for that. Okay, what is pairs trading? You'll also hear it called equity pairs trading or statistical arbitrage, but most commonly it's referred to pairs trading. Now, people do trade other things besides stocks and pairs. I know I have heard people who use options with pairs, but that doesn't really make that much sense to me. Also, people will trade futures in pairs, and you get the same sort of benefits. It extends your duration, and it takes a lot of risk out of trading futures. The problem is that most of the time, those pairings are much more speculative, right? If you're pairing the S&P 500 futures contract, let's say, with the bonds futures contract, they're not really that correlated. In fact, they're counter-correlated. Or they are sometimes. Lately, they haven't been. So what you end up with is in a situation where you're trading the relationship between two futures contracts, but it's much more speculative. In other words, you're saying the pair is at sort of an ebb in its the way they travel together, so I'm going to go long this pair. But it's something that can trend, right? The relationship can trend because they're not really correlated or not strongly correlated. So it's a little bit different type of trading. What we're doing is much more like an example of trading Coke versus Pepsi. Now, let's assume for the minute that Coke and Pepsi are similar businesses. They're not really, because Pepsi has a lot of food enterprises, whereas Coke doesn't. But let's assume that for the moment they're basically in the same business, and everybody understands Pepsi and Coke. They sell soft drinks. So they have this historical relationship. They're basically in the same business. So if something hits one business hard, it's probably going to affect the other business as well. So what we find over time is those stocks trade in a very similar way. And when the relationship between those pairs gets out of whack a little bit, what we'll do is we'll buy the weak one. Let's say Coke is weak. We'll buy Coke and we'll sell the strong one. Let's say Pepsi is strong. And then when they resume their normal relationship, we can profit from that return to their mean relationship. Now, one of the things that confuses people a lot is they think, well, if you buy one thing and sell the other, well, then what you want is the one you bought to go up and the one you sold to go down. And that's the natural sort of, inclination. It's the most obvious thing. However, that's not really what we're going for. We're doing a lot of work up front to find pairs that are that have a very similar relationship, and so we should expect going forward from the time we put on a pairs trade that they're going to have or continue to have a similar relationship. They're going to trade in very similar ways. So what happens most of the time, hopefully, is that we'll put on a pairs trade and then both stocks will go up, or both stocks will go sideways, or both stocks will go down, and that's just fine. That's what we want to happen. And because we're buying the weak one and selling the strong one, when they both go up, we're just hoping that the one we bought goes up more than the one we sold. Same way when they go down, we just hope the one we sold goes down more than the one we bought. Now, we want them to continue to travel in a similar relationship, but if we buy it at an inflection point, or we enter a pair at an inflection point where they're kind of deviating from their normal relationship, as they move up, down, or sideways, they will tend to resume their normal relationship, which will create a profit opportunity for us. Now, one of the things that we bank on is this return to mean, or to their historical relationship. And a lot of people over the years probably have been burned trading indicators that are sold, as a reversion to the mean. And there have been a lot of studies done on this, and stock prices don't really revert to the mean. In other words, if I'm using like a MACD or some sort of oscillator, you can find places in a stock, let's say, where it looks overbought or oversold, right? This is a very common thing. And we're banking on the fact that there will be this reversion to the mean. However, there have been lots of studies, and stock prices really don't revert to a mean. They trend a lot. And if you're trading some sort of oscillator, over time, it's just not going to be profitable. I know a lot of you listening today know that for a fact. I've done that. However, when it comes to the relationship between the pairs that we're picking, if we pick them properly, there is a mean reverting relationship. They will revert to their mean. Now, we don't know how long it's going to take, but there is a very statistically valid process of reverting to the mean relationship if the stocks continue to have the same business model. This is one of the things that gives us an edge in our pairs trading. So why trade pairs? The biggest reason, and probably the biggest reason for me and the biggest reason that most people trade pairs, is that it's really good protection against large market moves. In other words, there's a saying in stock trading circles that, when the market's tanking, that everything becomes correlated, right? In other words, what's behind that is when the market's going down, as it did, a couple of weeks ago, people want to sell everything. They don't care what it is, right? Everybody's running for the doors and they want to sell everything. So everything becomes correlated, not really. Basically, everything is wanting to be sold. So things actually return to their historical correlation. So what that means for us is that essentially in our pairs trading part of our portfolio, we're basically half long and half short, right? So if the market goes down a lot, certainly we're going to be losing money on the shares that we're long, but we're going to be making money on the shares that we're short. So we should actually make a little bit of money if we get this reversion to the mean, right? That's what we're going for when we enter the pairs. So we'll make a little bit of money going down, but we certainly won't lose a lot of money. So that's the main thing. So I know I speak to lots of options traders, over the years, and typically people aren't going to lever up their whole account trading options. So normally, they'll have 20-30% of their account trading options, but they leave the rest of their account in cash. So people can have 70-80% of their account in cash. So pairs trading is a way that I found to put that idle cash to work. And you can put a lot of money to work trading pairs and feel fairly secure and safe. So what we're going for is regular, small, high percentage wins. And this trading approach is valid. It's very popular in hedge funds since the 80s. So there's a lot of history with this type of trading approach. You're not going to hit home runs, so it's not really a sexy trading approach. But if you have a lot of capital you want to put to work safely, especially at market tops like we are right now, and even though we've had a downturn, we're still at historic highs, there's a lot of downside risk, right? If you're just sort of looking at it, what's the chance that the market's going to go to new highs, certainly over the next few months? Doesn't seem likely. There's not a lot below the market supporting it, so I think it's reasonable for someone to feel a little bit insecure if they're just long a bunch of mutual funds at this point. So pairs trading is a way to put that capital to work in a way that we can feel pretty safe about it when we're at market tops. Although this is used in hedge funds, and the individual trader has an advantage because we can trade in smaller size. We can do odd lots and trade whatever size we need to do to keep our pairs balanced, and the market's not even going to notice us. Whereas if you're a hedge fund and trying to do this, you're actually moving markets, especially in stocks, when you go to trade in size. So this is a very successful, sound approach. So because of this reduced risk, we have a relatively safe trade, or many relatively safe trades on, and we can kind of wait around to be right? We don't really have to rush exiting a pair because not a lot's going to happen. I know that I've been doing this for about 3 years now, and when I first started out, I did a lot of testing, and I would kind of do some testing, and then I'd come back to it. And I remember once I came back, and it was like a couple months later, I had done all this sort of testing, and so I just sort of brought up my software, and I looked at a bunch of pairs that I had been in, a couple months ago, and I looked at them expecting to see these big, huge losses, right? Because I'd been in it for 2 months and not managing them and not exiting them, and it turned out that most of them were profitable. I had a few larger losses. I had a few larger than normal wins, but most of them were just sort of normally profitable. So although when we get into one of these pairs, we have this instinct to try and get out as soon as we can with a profit, if you leave it alone, there's probably going to be many profit opportunities that come along down the road. So we don't have to be all panicky and whatnot about our positions, which is a psychologically pleasing thing, especially if you have a lot of money tied up in your pairs trades. And because we're not making a lot of money on any given pairs trade, most people feel comfortable levering up their trades in the pairs. And one of the ways you can do that is using portfolio margin. And with portfolio margin, you can actually multiply your returns up to 6 times. And the reason for this is that your broker, if you have portfolio margin, the way they calculate your risk is they look out either up or down about 2 standard deviations, and they look at your account and go, what's going to happen if the market goes down 2 standard deviation move? What's going to happen to this guy's account? And they'll take a look at each of your stocks, and this is all probably automated. They'll look at each of your stocks and they'll say, oh, well, you got all these long stocks you're going to lose money on. Here's all your short stocks you're going to make money on. They add it all up and go, there's not a lot of risk there. And so your actual risk in the account that's assessed by your broker is very low. And so that's essentially the margin that they're charging you, is that 2 standard deviation risk. Well, because of even out 2 standard deviations, you're not really having a lot of risk compared to the amount of capital in your account. You could trade a lot more than 6 times, but they have a limit. It's somewhere between 6 and 7 times the capital in your account. So they allow you to lever up quite a bit using portfolio margin. And it's a reasonable thing to do. Most of the time, people are very worried about, margining stock trades. But if you're half long and half short, you don't really have much risk. So it's a perfectly reasonable, conservative thing to lever up. 2 or 3 times, even 6 times isn't that outrageous. So we're making small wins, but you can turn that into some significant returns by using leverage. Okay, so this is an equity curve of a back test that I did, and I just wanted to kind of point out this section right here in the middle. And I'm not really showing you this to show an equity curve, but I wanted you to focus on this one section in the equity curve. If you'll notice, we have some pretty good run up here and a pretty good run up here, pretty much in the same slope at the beginning, at this ending period here in the beginning period, but in the middle, it's a lot steeper. And the reason for that is this is basically the 2008 period right here. And the takeaway from this is that implied volatility, when implied volatility goes up, or volatility in general, pairs trading does a lot better. So, not only do we not have a lot of risk in, a large down move in the market, it is actually a better time for pairs trading when the market's starting to get volatile. In fact, right now, after the sort of downturn in the last few weeks, our pairs trades are coming in with a lot bigger wins than normal. So that's an important takeaway, and it's another reason that you should feel good about trading pairs. Okay, risk management. So with pairs trading, it's pretty much a numbers game. It's a very sort of mechanical approach, and we're going to have winners and losers. However, over a 2-year trading period, here are some numbers to kind of give you some context. Now, there are quite a few trades in this sample, and in general, you're not going to take every single pairs trade that comes through our service. There's just too many trades. You want to take as many as you can, but it's not realistic that you're going to take all of them. However, this gives you some context and an idea in that pool of trades that's coming through, how do they behave. So in general, in terms of winning days there, you can see we have about 61% of our trades are winners. And you can see that there's a positive expectation there. That's a lot of trades, and 61% are winners. So we have a positive expectation of winning anytime we put a pairs trade on. And you can see the positive expectation reflect as you go out in larger time frames. So on a weekly basis, we're going to have 72% of our weeks that are profitable, and we're going to have almost 80% of our months are going to be winning months. So there's a very high probability of coming out ahead with the pairs trading, and we do that with very low risk. So on a risk adjusted basis, we're doing a pretty good job. Also, we want to have a large number of occurrences because this helps the probabilities play out. In other words, if you just did one pairs trade a month, it may be that one pairs trade that you're doing happens to be one of the losers, right? So we don't want to, we want to do enough occurrences so that these probabilities play out. Also, we want to trade each occurrence of a pair small to avoid one large damaging loss. So if we lever up one whole pair trade in our whole account, right? If for some reason one of the sides of our pair, the stock, has some unusual situation happen, it's not going to cause a big damage for our account. So we like to trade each of our pairs smaller and trade, if we want to put more money to work, we trade more pairs instead of increasing the size of our pairs. The stock-specific risk is kind of hard to control. If you have like the CFO absconds with all the money to Bermuda in a company, or there's some accounting irregularities that are brought to light, or there's some, criminal investigation, that's going to hit the stocks pretty hard. And, that can happen in one side of our pair, and all of a sudden that relationship that we're banking on is out of whack. And obviously we'll have to exit the pair, but sometimes there's no way to know these things in advance. There are some things that we can know in advance. That's why we check the news regularly, and that's also why we have a hedge. That's why we trade one side of our pair long and one side short. So anything that happens in a big way on one side of our pairs hopefully is reflected in the other side. Also, we try not to trade one stock more than once in our portfolio. In other words, if we've got, let's say, 20 pairs on, we don't want one side of each of those 20 pairs to be the same stock, right? Because then we're right back in the same boat. It's as if we're trading, one pair in our account, and that one side of the pair has some unusual thing happen. So I try to trade each stock only once in my portfolio of pairs. And it's a good thing to paper trade at first when you're starting to pairs trade, just to get in sync with the administration, because it's a little bit new for people. Usually we want to get the short side of our trade off first, because sometimes, even though we try to do our best job curating our pairs list as possible and make sure that most of our stocks that we are potentially shorting are easy to borrow, all of a sudden stocks can become hard to borrow, and there's no way for us to predict that. If it all of a sudden becomes really popular, the broker runs out of shares that they can lend out for shorting purposes. So we always try to get the short side off first, and if we get that one on, then we can always come back and do the long side. It's usually not a problem filling long trades. All right, our pairs trading service. So once you go through the course, you should be able to know everything there is to know about pairs trading, at least that we think is relevant. And the next task is to find pairs, do the analysis, and have a pairs list that you're willing to trade. So our pairs trading service does all that work for you. And we also provide proprietary signals for opening and closing the pairs trades. Now, the way we do our analysis for signals, in other words, finding a pair that's ripe to be traded, we look at each of the stocks separately. So we're doing our analysis on each stock individually and then looking at them as a pair. And so if we can say individually this strongest stock, or excuse me, this stock is strong, and individually this stock is weak, and they happen to be in a pair, now that's a perfect storm, perfect situation where the pair is ripe to be traded. Now, if you do a lot of Googling on pairs trading, you'll find that most pairs trading services or pairs trading approaches use a method called spreading. And so what they do is they sort of normalize the price of each stock, and they create this sort of spread between them. And what happens is when the spread gets to, like, say 2 standard deviations, something like that, they'll think that the pair is ready to trade. The problem with using spreading as your method is that a lot of times the spread, as it were, can trend. In other words, the stock can just sort of hit this new zone where they're just sort of spreading away, and they just sort of trend that way. And so there's no real way to exit the trade. So you can get stuck in it for a really long time, and there's nothing that's going to give you a signal to say, hey, it's time to exit this pair. So you can end up with lots of large losses. So by doing our analysis on each stock separately, not only do we have an immediate way to identify a pair as being right for trading, but that relationship, by its nature, tends to either come back quickly or give us a signal saying that there's no longer this ideal trading opportunity, and we can get out of our trades quicker. So that's an important distinction between other pairs trading approaches, because we don't want to get stuck in these trades that just keep losing money. We want some way to get in and some way to quickly get out if it's not working in our favor. So in short, you can outsource the drudgery of maintaining and curating your pairs list and also monitoring the list for signals if you sign up for our pairs trading service. Trades are usually closed in less than 3 weeks. Most of our trades actually close in a number of days, but like something like on the order of like 95% of our trades are closed in less than 3 weeks. Okay, brokers and commissions. I don't really want to get in between your broker relationship. I don't really recommend any brokers. However, the important takeaway here is that with pairs trading, you need to keep your cost low. We'll be trading a lot of odd lots, right? Because we want to do equal dollar amounts on each side of our pair. So that means that we may be trading, 83 shares on one side and 142 shares on the other side of a pair, right? And we don't want to have to trade in 100 share lots. So you're going to be trading a lot of odd lots. So what we want is a commission that's based on a per share basis with no minimum ticket charge. So we need those commissions to be well below a penny per share with no minimum ticket charge. And that's going to be pretty hard to find with most brokers. They usually want to charge, $7.95 a trade, things like that. But that commission structure just won't work for pairs trading. So you can shop around for this type of a low rate. However, if you're having a hard time finding a broker that will give you those commissions, I do have a contact with a brokerage firm that you can talk with, and I don't want to really be in the business of endorsing brokers or anything, but I can help you out and get you the right contacts. Okay, so that was probably a lot of information there. I know you probably have generated a lot of questions. I see some questions in the chat. But if after the webinar you have any questions, go ahead and you can email me at john@consistentoptionsincome.com. Also, you can check our website for more information at consistentoptionsincome.com. Usually after a webinar, I get kind of swamped with emails, so give me a little bit of a break. It may take me a couple of days to get back to you right after the webinar, but I'm usually able to answer all my emails. So I know you probably have lots of questions, so let's try to get to them. All right. Okay, Mike's saying we were talking about end of day trading, right? That's a good question. So the pairs trading service is looking at the pairs constantly throughout the day. And so you'll see an opening trade or a signal coming by saying, hey, this pair is ripe to open long, let's say. And when I say open, long, or short, it's usually the first symbol in the pair that we're talking about, long or short. So if you have a particular pair and I say we're going to open the trade long, it's just the first symbol is long, the second symbol is short in that case. So if you see a signal come through like that, we're using daily bars to find those signals. So during the day, we can get a signal to say this particular pair is ripe for trading long. And then as the day wears on, let's say the prices of the stock change during the day, all of a sudden the signal may disappear. But usually the signals are fairly persistent. So that's one of the reasons that I created the free pairs trading indicator for NinjaTrader. So what you could do is maybe you just have a certain time of day where you're going to do your analysis and you start looking through the open signals and you just start reviewing the pairs in your software on the charts, and you know, some of them may have disappeared, some of the signals may still be valid, so you can just sort of enter the pairs once a day. I know a lot of people do that with their exits. They'll just do their analysis once a day because you know, there's no reason to panic about any of these pairs that you have open. So they just look at the charts, maybe a certain time of day, and just say, hey, that pair is ripe for exiting. I'll just exit the pairs that are showing exit signals at the moment on the chart. So you can kind of manage it the way you want. Some people might try to, you know, to take the signals right away whenever they get them, which is perfectly fine too. But in general, you know, pairs move pretty slowly, so it's pretty easy to get in and out of. And maybe if you're doing it one time a day, you know, you do it the same time every day, something like that. All right. Okay. Ron's asking, how does one position size for pairs trading? Okay, that's another good question. It's kind of a difficult question because at the low end, you want to make sure that you're trading enough size so that the pairs can be equally weighted on both sides of the pair, so the stocks can be equally weighted. In other words, let's say that we have a stock that's like, say, $83, and then we have another stock that's $42. Well, if you're only trading $100 on each side of your pair, right, you can only trade one share of the $83 stock and two shares of the $42 stock. And so your pair's not going to be weighted evenly. You know, you can come up with more extreme examples. You got a $90 stock and a $20 stock, right? The chances of you getting, with only $100 on each side, equally weighted, it's not quite as good. So the larger larger dollar amount you trade on each side of the pair, the more likely it is that you're going to have equal weighting on both sides. At the other end of the spectrum, you just don't want to trade too large on any given pair because you want to be able to hold a number of pairs to get the probabilities to work out. So I think once you get comfortable with it, you know, and you get into it, you're going to want to, if there's any capital that you're not using for other trading purposes, you're going to feel pretty comfortable deploying it because it's a pretty safe way of trading. So you know, at the end of the day, nobody can really tell you how to size your positions because that's ultimately a personal decision, you know, your assessment of the risk and what your risk tolerance says. But in general, I don't find that people worry about leveraging as much capital in pairs as they want. It's just at the low end where you can come into problems if you're trading with too small account. All of a sudden now each side of your pair isn't evenly weighted. Okay, and Ron's asking, how are exits handled with pairs trading? So with the NinjaTrader indicator, you'll see that when the indicator gets to a 1, that's a shorting opportunity, and when it gets to 0, that's a buying opportunity for that pair. And when it comes back to the middle of that range at 0.5, that's an exit signal. So we're seeing sort of an extreme in the pair at 1, so we want to sell that. And as soon as it sort of normalizes back at the middle of the indicator at 0.5, that's our exit signal. Also, I broadcast the exits for any pair that I have the service has broadcast as an open opportunity. We also follow up and give all the closing signals for all those trades that we have opened. So you can either wait for the pairs trading service to signal the close, or you can monitor your open pairs in NinjaTrader with the indicator. Obviously, the software that's sending out the alerts, it's vulnerable to technical difficulties. So I usually tell people it's probably smart to do a little bit of both. Maybe you can sort of lean on this automated signals from the service, but also check your indicator a couple times a day or something. Ron's asking, typically what type of stocks are used in pairs trading? For example, S&P 500 stocks. So we do have quite a bit of criteria. The free pairs trading course on the website goes into some of that. But generally speaking, we're looking for stocks that have pretty decent trading volume, over 300,000 shares a day. We eliminate a lot of stocks that are more volatile, like biotechs or oil exploration, that sort of thing. Things where it's more routine to have sort of aberrant stock moves. So we try to get rid of those, but we also do a lot of mathematical computations to make sure the stocks are co-integrated. And co-integration is kind of a word that people kind of use it like correlation, but it's a little bit more mathematically intensive. You can't really come up with a single number for co-integration, but what co-integration, the mathematical process, tries to evaluate is, hey, there's these two data streams, and what is the likelihood that when they deviate, they also come back together, and how frequently? So in a nutshell, that's what co-integration is. So we do a lot of analysis in that area. So it's very important, put it that way, it's very important to pick the stocks that you're trading wisely. So we put a lot of emphasis on that. Just finding the signals is easy. Curating the pairs list is the hard part. Yeah, Arthur's asking, are you buying and selling equal dollar amounts or equal number of shares? Yeah, I think maybe I answered that since you typed it in. But yeah, we're trying to do equal dollar amounts on both sides of our pair. If you just did the shares, that wouldn't help too much. We think that the pairs moving forward are going to behave in exactly the same way, so we want the dollars to behave in the same way as well. Okay, Mike's asking, can you show the NinjaTrader indicator to get NinjaTrader? We need to join the service, right? So in the free pairs trading course on my website, I think there's a video called, something like setting up the NinjaTrader indicator or something like that. You can look at that, and that'll give you some good examples of the NinjaTrader indicator and how it works and how to set it up. But yeah, you'll get, you'll get the free NinjaTrader indicator when you sign up for the service. But if you cancel the service, you decide you don't like the service, you can keep the indicator. It's free. Ron's asking, he's asking about Interactive Brokers and pairs trading. Interactive Brokers is definitely one of the lower priced brokers out there, and they actually come pretty close to having good commissions for pairs trading. However, they do charge $1 minimum. So any given trade, they charge per share, but you got to do at least a dollar, right? So if you're trading smaller size and whatever you're paying for share doesn't add up to $1, they'll charge you $1 as a minimum. So if you're trading larger size, they're probably fine. But if you're trading, in pretty small size, that dollar is going to eat away at your profits. So there are brokers where you can do better. Rob's asking, can you show some examples? So there are a number of examples on the website in the pairs trading course. So that's where I would steer you to look for some examples. And if you have any questions, just let me know if there's any questions about those examples. Okay, Herbie's asking, what is the average % gain on your positive trades, and when do you close out trades that go against you? Any specific guidelines? So there's a few questions there. So the average % gain, you know what? I know the dollar amount. So all the examples I have, in fact, in the service, when you get a trade, it comes through with the number of shares to trade, but it assumes that you're doing $10,000 on each side of the trade. So if you were to do $10,000 on each side of a trade, so you're essentially putting $20,000 to work. I'm actually calculating the percentage right now. So the dollar amount, the average, I did this calculation a while ago, it's about $195 per pair is the profit. So that works out to be about 0.1% per pair. So that's why we want to do lots of pairs. So we're not making a lot. We're making that 0.1% safely, and hopefully we're doing it in just a couple of days. And then hopefully we're using some leverage to increase that 1.1%. So the profits are small, but they're very safe. They're on a risk-adjusted basis, and they're very consistent. And so that's why this is a good way to put a lot of capital to work. And when you close out the trade, so basically we're looking for this relationship. We picked our pairs because we think they have a good relationship, and then when we find that they're deviating from that relationship, we're going to enter the pair, and then when they return to a mean, which on the indicator is at 0.5, it's right in the middle. You could wait longer than that. I know some people who will go short a pair at 1 and then exit the pair at 0 because they're not really worried about it. There's no reason to panic. So you can have a lot of patience with your pairs and just wait for your pair to be profitable. You don't necessarily have to take the signals right away. Arthur's asking, do you sign up month by month? Yes. So there's really not a lot of risk here with what I'm offering. The pairs trading service is $49.95 a month. You get the course for free. Generally speaking, with the options course and whatnot, I've kind of taken the view that I wouldn't really want to be dependent on somebody else for my trading. So that's the reason I taught the options strategy as a course, so people could learn a skill and then they could walk away with it. However, with the pairs trading, if I just sold the course, sold it as a pairs trading course, I think people would get to the end of it and they'd think, this is too much work for me. So I kind of did it a little bit different with the pairs trading and said, here's some automation. I've automated it for my own trading. You can take advantage of it as well. And so instead of having to pay a lot up front for the course, you can sort of tip your big toe in the water and for a pretty low cost monthly fee, sign up and see if it works for you or not. And when the trades come through, on the service, all of them tell you the number of shares based on $10,000. the exact prices that were found at the moment. And on the closing trades, you'll see the P&L right on the trade alert. So it says, here's a trade we opened, we're closing it now, and here's the P&L that you could have made on it. So just if you just signed up for a month and just followed the trades, it'll give you a pretty good feeling for, like, you know, how many trades there are, and you know, what the profits look like. One of the things to note too is that after a big market downturn, like we had the last 2 weeks, you know, the calculations that we were doing to find our trading opportunities were kind of skewed by that big move, right? It took a little bit of time for that sort of to work itself out. You know, there's this sort of, it's kind of like, you know, a python that swallowed a pig or something. You know, it takes a while for that big move to work itself through. So we actually had fewer trades than normal over the last few weeks, but it's starting to pick up again. So if you sign up for the service, you'll see there's plenty of trades in the data to choose from. And, you know, the way to view it is, hey, there's this rich pool of profitable opportunities. I can take as little as or as many as I want. Okay, thanks, Del. He was just saying, I guess I should read it for you guys. So he says, this is really fascinating stuff. Seems like a fresh and different, more logical approach to trading. We'll be going to your website. So thanks, Del, I appreciate it. Ron's asking, starting capital recommended. That's a pretty tough question for me. Like I said, you know, I guess I would probably feel not as comfortable starting with less than let's say $1,000 per side of the pair, so $2,000 for each pair, and then you'd want to have enough capital to do that. Let's say at least have 10 concurrent pairs open. So I guess that, you know, saying it that way, maybe $20,000 is probably as small as I would start with. You know, $1,000 gives you enough room on each side of the pair, so you know you're trading pretty close to equal dollar amounts. You'd mind if you only have $1,000 per side, you'd probably want to avoid, you know, large dollar amounts, shares that are coming in large dollar amounts, like a Google or a Netflix or something. Maybe stay below $100 or something like that. And then you want to trade as many of those pairs as you can. So you'd want to have enough capital to do that. If a trade is profitable at 3 weeks, why not hold on to it for a few more weeks in anticipation of a greater gain? Okay, so that seems like a logical conclusion. However, remember, we're trading a relationship between the pair, right? So one of the ways you could restate what you said is, okay, I'm getting an exit signal on this pair, but maybe there's not very much risk in holding it, so I'm going to hold it longer until I either break even or have a small profit, right? So that might be reasonable, but we're never going to get like greater gains, right? Because we're trading the relationship, and if we did a good job picking our pair, that relationship's not going to get that horribly askew from each other, right? It's going to stay pretty much the same. That's what we want. So you're never going to get a greater gain by holding on the pair. However, you could take a loss, in other words, you're getting a signal that the pair's returned to its mean, but maybe you're still in a small loss, so maybe you want to hold it longer and hold it until you break even or have a small profit, you know, just to get out of the trade to prevent a loss. That makes sense, but it doesn't make sense to stick around for greater gains because they're just not likely to come. It's one of the limitations. We're giving up the potential for unlimited profits, right? If we just buy IBM or something, right, we think we have potential for unlimited profits. We usually don't, but you know, setting that aside, we're giving up some of that potential unlimited gains by trading two stocks at one time, you know, one short, one loss, or one short and one long. We just don't have huge upside potential. So I hope that helps. And Mike's asking a similar question I probably already answered. He said, how large an account do we need to start? So I don't like to really put a number on it because everybody's different, but if I kind of look at sort of where my minimums fall, you know, $1,000 per side. I mean, maybe you could go down to 500 if that helps you get 10 trades, but I'd probably feel closer to $1,000 a side. So to answer your question directly, I'm thinking maybe 20,000 would be a good starting capital at the minimum. Okay, Dana's asking, what is a drawdown in pairs trading? I don't really have any good drawdown statistics for you. You know, most of our trades are small winners or small losers, and we win more often than we lose. I don't really, in other words, no one's going to take all the trades. So if I was I could probably calculate a drawdown if I looked at all the trades, but I'd have to look at like which ones are concurrent, right? I could probably come up with a drawdown, like say on any given trade, here's like your average drawdown while you're in the trade. I don't have that number, but I probably could come up with it. But it's kind of hard for me to look across a pool of trades, potential trades that we didn't necessarily take, and then figure out a drawdown from all the open trades at any given time. And you'd have to look at both sides of each pair as well. So it's actually not, it sounds like a fairly easy question, but it would be pretty difficult to do, and I don't have those numbers for you. Sorry. What's the name of the NinjaTrader indicator? I think I just called it COI Pairs Trading Indicator. If you sign up for the service, I'll send you a link to it, and you can just download it and install it in NinjaTrader. It kind of looks like an oscillator. It's not really an oscillator, but it just gives you a value of 1 to short a pair, a value of 0 to go long a pair, and a value of 0.5 to exit an open pair. Okay, Mike's asking a good question, and it's a question that I took a pretty hard look at once because I'm pretty much, you know, by history an options trader, and so Mike's asking, can you use options instead of stocks, like a call spread on one and a put spread on the other? So it seems logical, and that you could use options because you get a little bit more leverage, you get a little bit of safety, because it's maybe, you know, you said call spread, I'm assuming it means like a debit spread or something. So you have some fixed risk in the options trade. So it kind of makes sense, and especially when I say, hey, you know, we'll go long one stock and short the other stock, right? And does it really matter what I use to go long, or does it matter what I use to go short? It makes kind of sense, but the thing is, once you start trading pairs, you realize, because of the way we've curated the pairs list that we're dealing from, once I enter a trade, the stocks pretty much behave the same way going forward. So what that means is that if I have a fixed, let's say I'm doing a debit spread, first of all, I've got to overcome all that premium if I'm long options, right? Very difficult to do. And because we're going for such small profits, if you're long options on both sides, there's probably no way you're going to overcome that premium. It's just not going to happen. However, maybe what you'd say then is, well, I'll do 2 credit spreads, right? I'm selling premium instead of buying it, which does make more sense. But if you remember that the stocks the long one's not going to go down and the short one's going to go up at the same time, right? If that was the case, it'd be fine. But that's not what usually happens. So the one that we're long, let's say that that's the one that both stocks are now going up instead. That's what happens after we enter. On the long one, at some point on that credit spread, your profit is capped. But on the short one, right, since it's going up, you have basically unlimited, let's assume you're doing naked calls and puts, you have unlimited risk, or even if it was a credit spread, you've got a lot more risk than your profit potential. So what that means is that your profit on one side will get capped and your loss on the other one is unlimited, or at least larger than the profit that's being capped. And so it's not perfectly hedged is really the point if you're trading options. So you want to be kind of careful with that. It seems like a good idea, but in practice, it's a little bit hard to overcome because we're going for such small profits. The stocks are a much more direct way to hedge, and if both stocks are moving exactly the same moving forward, it's much easier for us to take our profits as well. We don't have the kind of bid-ask spreads you get in options. I think your trading costs with options just could eat up all the profits. You know, if you were to find two stocks that you wanted to trade together, you know, and you think one is actually going to go up and the other one's actually going to go down, now that's more of like an options pair that would be worthy of doing, you know, maybe on futures contracts or something like that. But on stocks, because we're doing small profit targets, I just don't see it working. I've never been interested in doing that. John's asking, do we have an indicator for Thinkorswim? No, not at the moment. You know, if the service becomes popular and you know, down the road, if there's a lot of requests for the Thinkorswim, we could look at creating the indicator for Thinkorswim. We just don't want to have one at the moment. The only indicator I have is for NinjaTrader. NinjaTrader is pretty much free if you don't trade through it, so it's pretty common software that most people have. Ron's asking, do you have a site that we can see the openings and closings? Yes, the way the signals are delivered, they're delivered on Twitter. Some people have thought I deliver them via email, but email's just a little bit too slow. It's not really instantaneous. So they come through on a private Twitter account. So when you sign up, I give you access to that Twitter account so you can see the trades coming through all day long as the the market's open. Arthur is asking, how important is co-integration versus correlation? Well, correlation is pretty weak. I know there's a lot of pairs trading literature out there that says, okay, we'll just trade two correlated products, but correlation is a very sort of weak description of a relationship, right? It could be that something's correlated and we could never be profitable trading pairs on that those two stocks the way they're correlated. Right. So what's more important is co-integration. Do the stocks deviate and then come back together? That's the important part. So co-integration is much more important than correlation. Also, when I'm curating the pairs list, I'm looking to see how the stocks are actually behaving together. Right. It could be that something's correlated and it's co-integrated. Two stocks are co-integrated, but they don't trade well together. They're not profitable. They don't have a positive expectancy, so I'm going to cull those out of our list. Also, the biggest part of what comes through in the curation of the pairs list for the pairs trading service is that the two stocks are in the same business, right? That's key, because even if, like, let's say earnings come out on one stock, but if they're, it's kind of a surprise maybe. Well, if you've paired it with the stock that's basically in the same business, there's going to be a lot of sympathy that says, hey, if Coke has just had really great earnings, there's a pretty good chance that Pepsi did pretty well last quarter as well. So that's really the part that takes the most time, actually, is making sure that the stocks that you're trading are really have kind of the same business model. So we use math, we use quite a bit of analysis on the individual businesses as well. So all that comes together, we end up with a pairs list that trades very well together, and we just sit there and take the trades. Arthur's asking, are the pairs in the same industry? Yeah, you would think so, and obviously most time they are, but once you get into sort of industry and sector designations, you'll realize that there's probably about, I don't know, I never really counted, but I found multiple different services that provide sector and industry information, and they're not aligned. You'll see a pair that's in the same industry with one service, but it's in a different industry with a different service. So there's really no consistent consensus on what is the same industry in the same sector. So it's really not a big help. It's certainly better than nothing, but because there's such a diversity between services that provide industry and sector information, it kind of is a red flag that, hey, maybe this isn't so easy, right? So once you get into it, I think you'd see that. Charles is asking, is there any discount for prepaying for the service yearly? You know what? I don't have a yearly subscription yet. I'll consider that down the road. I'm trying to keep things simple for the moment. I don't, this is kind of a part-time thing for me, so I can't spend too much time on sort of administering things, but it seems like a logical next step, but I just don't have it at the moment. Arthur's asking, what is the average time for a trade, days or weeks? So I did some analysis, and basically 95% of our trades are done in 3 weeks or so. So if you wanted to start saying, hey, I don't want to trade these pairs during earnings, as long as you're 3 weeks out from earnings, you're pretty safe. But most of our trades conclude in a matter of days, 2 to 3 days, trading days, obviously. So we get a pretty good turnover, but at the outside, you're looking at weeks, not months. And by the way, just since I brought up earnings, a lot of people in trading pairs are pretty skittish about earnings. You'll find that once you start trading pairs, if you eliminate stocks that are having earnings, you don't have very many opportunities. All of a sudden, earnings seasons will come along. All of a sudden, your pair trades that are coming through have just sort of evaporated. And my experience is that, yeah, you open yourself up to a possible big move against you because of earnings, but remember, you've got another side of that pair, right? And usually the other side of the pair is fairly sympathetic. If we've done a good job picking our pairs, the other side of your pair is pretty sympathetic to those earnings. Even if they don't have earnings that day themselves, the other stock that you're trading will probably move in a very similar way, because that's why we picked that pair to begin with. So I tend to stick with it. It's kind of a 50-50 thing. Sometimes it's going to break your way, sometimes it's going to break against you, but in the end, it it's kind of nets out to not being a significant concern. So I trade right through earnings. But you could filter it out if you want. So anything that's less than 3 weeks out for earnings, you could just pass. Okay, Chin is asking, why did volatility in 2008 help the return? Well, it's just, it really doesn't matter what trading approach you're using. If stocks move around, or any tradable, it's a futures contract or options, indexes, it doesn't really matter. The more it moves around, the more opportunities are going to be. It's kind of an axiom that's held true over my trading career. So in 2008, what would happen is, two stocks that have been, in the same business, very correlated, all of a sudden just the big moves make them sort of become, deviate from their normal relationship, and then the big moves in the other direction make them come back together. So they're just going apart and coming back together in a much bigger way. And so that helps our returns, the size of our returns. And you can see that in the steepness of the equity curve in 2008. So volatility is a good thing. It really doesn't matter what you're trading. If you're a trader, volatility is always a good thing. Okay, Ron's asking, how's the communication with your service handled? Right, so I may have already answered that. The signals come through on Twitter, and you can use there's a video in the free course on how to set up your Twitter account to get the signals, and And you can use like in the video I go into how you could use TweetDeck to kind of help you monitor Twitter. So those signals come through real time. So it's the best approach I could find that has sort of an ease of entry for people, and it's almost immediate. Ron's asking, can you give us an example of leverage and how it works? So it's not very complicated, really. So in your account, let's say you have the $20,000. Actually, you'd need more than that for portfolio margin, but if you just had a Reg T account, they're going to let you trade twice as many or twice the dollar amount of shares as you have capital in the account. That's sort of a typical margin, but they're going to assess you. You're probably going to end up paying some margin fees on that. Whereas if you have like portfolio margin, they're only going to assess you margin for your risk. And because your risk is so low and you've got so much capital in your account, you got plenty more capital than the risk that you're taking. So, you know, they're going to let you trade up in size. So even, let's say that you had a $100,000 account, they're going to let you trade $600,000 in stock, long and short, because if they look out to standard deviation, you have nowhere near $100,000 at risk, and you actually had $100,000 in capital in your account. So it's just a matter of how many pairs you can trade. Really, there's really no example. It's just you're going to be able to trade more pairs than your 100,000 would normally allow you. If you're trading 20,000 per side, let's say you have a $100,000 account, typically you'd think you could only trade 5 pairs. Well, even in a Reg T, you could trade 10 pairs, and in a portfolio margin account, you could trade even more. John's asking, the 195 average profit you said was for 10,000 per trade, or $20,000 per pair trade. That's correct. So we're looking to make $195 or so. Again, we're following the signal, so we don't really have a profit target as such, but that's just the average. So if you're trading $10,000 per side, so you've allocated $20,000 to that pair, you're making $195 on average, and you know, that's over a few days. So it may not seem like a lot, but you're making 0.1% in just a few days. It's, you know, over time that starts adding up. It's pretty good. And if you add some leverage to that, you know, even better. Okay, Charles is asking, can you use option contracts as a substitute for buying shares outright? Like I said, for this particular trading approach, I don't think so. Hopefully you heard when I covered that earlier. I just think trading stock shares is much more of an immediate hedge, and you just have too much overhead with options. I know people, you know, you'll read some stuff out there probably on the internet about people trading pairs with options, but that's much more of a speculative trade. You know, you're thinking, I think this tradable is going to go up, and I think this tradable is going to go down, so I'll do some options trade on it. Whereas all the pairs that we're working with, we think they're going to do the exact same thing going forward, right? And so you don't have as much opportunity to overcome the extra costs involved with options trading. Okay, Terry's asking, what's the minimum account size for this kind of trading to make sense? Hopefully I've covered that. I'm thinking, you know, $1,000 per side, and you want to hold at least 10 pairs, so $20,000 account makes sense. Okay, John's asking how are alerts sent. I think I've answered that. They come through on Twitter. Herbie's asking about, you know, what do I think about the latest Department of Labor regs to prohibit option trades and IRAs? I'm primarily an options trader, so I understand the angst over that. Um, Again, it's sort of the government trying to help everybody out, right? Um, Obviously, if you can't trade options in your IRAs, that's going to hurt a lot of people. I think a lot of the rules have more to do with fiduciary responsibility. In other words, they're money managers who take liberties with clients' monies without disclosing risk and that sort of thing. So I'm hoping that clearer heads prevail, and self-directed traders are going to continue to be able to trade options in their IRAs. Maybe you have to sign a release or something like that, but hopefully that won't be the impact. Now, just since you brought up IRAs, with the pairs trading approach, we really can't use it in an IRA because we're shorting stock. That's one thing you're not allowed to do. Whereas my options strategy that I teach in the options course, that works perfectly well in an IRA because there's no unlimited risk and there's no short stock. Arthur's asking, how long is the historical look-back period that you look to choose a pair? Well, there's two aspects to that. One is like, how do I decide? Okay, so one aspect, the easier side is, okay, when do I look for an opportunity? I'm only looking a couple weeks back on a particular pair. Once I've decided a pair is good, I'm only looking a couple weeks back to decide whether the opportunity is ripe or not. In order to choose the pair, I'm actually looking at multiple time frames. I'm looking at the relationship, especially for co-integration, like on a 3-month period, a 6-month period, a 1-year period, 2-year period, like that. And also I'm looking like how have they traded together over the last year in actual trading. So I'm actually using multiple time frames for the different pieces of the analysis to come together. So hopefully that answers your question. John's asking, if we sign up for the service, can we see how each trade in the past is done? Does it show a track record for closed trades? There's no place to go easily. If you're really interested in that, I could probably put together a spreadsheet. It would probably have hundreds of thousands of trades and it'd just be data, but I could provide that to you. If you go on Twitter, you can scroll through quite a few trades. I believe those tweets are kept there for quite a long time, so you can just scroll back quite a long ways, and you'll see on all the closing trades the P&L. But if you wanted it in a spreadsheet or something, I could probably provide that. Again, it's what I have is like a pool of trades, not necessarily trades that were taken, because the service records every trade opportunity that comes along, and then the corresponding closing opportunity for that trade. And so you'd be able to see the P&L on all the closing trades. Mike's asking, assuming we had a $20,000 account to get started, what kind of return would be reasonable to expect per month and per year? I don't really have a good answer for that, Mike. I'm sorry. On average, you're going to get, like I said, 0.1% per trade. But it depends on which trades you pick, right? I mean, if I'm looking across the whole pool of trades, I don't think that'd be a realistic assumption that you're taking all the trades. So it's kind of the pool of data that I have. So I think it's better to focus on, okay, I'm looking at 0.1% for on average for each trade, and what's that going to work out depending on how many trades I take. So you can probably do the math yourself, but I don't really have a track record like that, where we can calculate those kind of returns. Ron's asking, what's the probability of constantly picking the 25% of your picks there are going to be losers. Oh, right. So if you had the worst possible luck ever and you took all the losers instead of the other, winners, it seems like it'd be pretty unlikely. That'd be pretty hard to do. I don't know how to calculate those odds, but I would think it's safe to say that the pool of trades that are coming through are very have a high statistical probability of winning, and the returns are going to be small, but for you to pick all the losers seems pretty unlikely. I wouldn't really worry about that. I don't worry about that. And actually, once you see the trades coming through, you'll see that lots of the trades are winners. It would be pretty hard if you tried to pick all the losers. I guess it's certainly a possibility, but I think I would think of it more in terms of, okay, if I'm trading any sort of trading approach, whatever it is, and I'm not taking all the opportunities, the probability is still the same of any given opportunity being a good one. Yeah, Owen's asking the same question about annual returns. I just don't have those numbers, Owen, to figure out an annual return. I think, what I'm selling is a pool of trades that have a, high opportunity of being correct and on average making about 0.1% per trade. And so I think you'll just have to do the math yourself on that. I don't really have a track record. I'm not managing money or anything like that. I'm just, providing a pool of good trades. So Ron's saying, my account is currently 280,000 with a lot sitting on idle as I trade futures. So this sounds very good to me. Right. Futures traders, like if you're day trading, they're very rarely using their whole account. And for guys like me who are options traders, we don't use our whole account. So this is a good way to just, it keeps you a little bit busy, gives you something to do, allows you to trade without, a lot of like stress and risk. And, you feel really good about putting that money to work, especially in these days where there's no like sweep account where you can get like 2 or 3% on your money, right? You're getting like 0 on it. So here's a way to kind of put a bunch of capital to work, and you can put all of it to work plus more, right? You can get some leverage on it. So it feels really good, Okay, Rob's asking, can you elaborate more on the difference between correlation and co-integration? So correlation, you can do that in like Excel, right? You can put like all the closing prices of like say Pepsi in one column and put all the closing prices of Coke in another column, and then you can, I think there's actually a formula in Excel for correlation, and so you can figure those numbers out pretty quickly. However, just because something's correlated, it could just be happenstance, right? In other words, there's a lot of times where you could look at certain periods of time in the past few years where you could say bonds and stocks are correlated, but everybody that's been around a while and all the big money managers will tell you, oh no, you have to have bonds and stocks in your portfolio because they're not correlated. When the stocks are going down, bonds are going up, and vice versa. Well, there's lots of periods of time where that hasn't been the case. So would you want to trade those as a pair? I don't think so, right? They're not really, it's not really telling you much. And you could have two things that are correlated, they travel in a very similar way, but they don't really trade well together. In other words, they don't come back to some mean relationship. And so that's what co-integration is trying to unearth is, these two data streams, when they deviate, in other words, they seem correlated, but when they deviate, what is the propensity for them to come back together? In other words, that's the sort of integration part, I guess. I don't really understand the origins of the term co-integration. I guess that just means two integrated, how integrated are the two things. But for us, what matters is that co-integration is a much better way to tell if moving forward, two stocks that deviate, what are the chances that they're going to come back together? And we want things that are highly co-integrated so that they do come back together. Herbie's asking, I guess you don't enter pairs traders prior to earnings release, or do you? No, I don't worry about earnings. I know some people do, some pairs traders do. It's kind of a 50-50 shot, right? And if we've done a good job on picking our pairs, even though only one side of our pair has an earnings release, the other side's going to be sympathetic, right? Because it's in the same business, it travels in the same way. So I don't worry about it. But if you were worried about it, you could just check the earnings dates prior to entry, and if the earnings dates are more than 3 weeks away, you're probably good to go. So it's up to you. Rich is asking, how much capital do you need to make 500 per month? That's kind of another way of asking what's sort of the monthly or annual returns, which I don't have. With the options trade, we have a target, and our target, our purpose of the options trade, the option strategy is to create a monthly income. So we're targeting about 5% of the capital we're putting up, so we can figure those kinds of things out. However, with the pairs trading, like I said, it really depends on how many trades you're doing. So if we're getting like, $195 per trade, trading 10,000, you can kind of figure that out. You need at least 3 of those kinds of trades. But if you're trading smaller than that, and you wouldn't want to just trade 3 trades, right? So you don't want to do 3 $10,000 trades. You probably want to do some smaller trades, and getting 0.1% for each of those trades. And a lot of times we're getting that 0.1% over a few days. So maybe the capital requirements might be the same. So that would be 3 of those trades, so like $60,000. But you could do that in a lot less than a month. So if you had $60,000, you're only trading 3 trades, $10,000 each side, and you had 3 winners, let's say, that gets you over the 500 right there. But you probably want to trade more pairs than that so that the statistics actually work out. So I'm sorry, I don't really have a good answer for that. But you can kind of figure, I think you can kind of back into it. If you know you're making about 0.1% per trade, figure out how many trades you want to do, what size you want to do, you can kind of play the numbers, and you can back into that 500 per month. Okay, Rich is asking, do I need to be aware of dividends and earnings? Okay, I think I've already addressed earnings, but dividends are the same way. I did a study, it was like over about a year. I kept track of all my dividends, because when you're short stock, you're forced to pay dividends, right? And if you're long stock, you get paid dividends. So since I'm long and short lots of stock, I just kept track of all my dividends over about a 1-year period, and it was pretty much worked out to be 0. It was right at 0. I mean, people hate to pay dividends, right? If they're short of stock, they're like, oh, they call it dividend risk, right? But it's just, you got to pay the dividends. So what? It's not usually a lot, and you probably have another. If you're trading enough pairs, you probably have another stock in your portfolio that's, being paid a dividend. So over time, it just works out. It just evens out. So it's not something that I worry about. The only caveat, and I think I mentioned this in the course, is that I don't want to go long or short a stock on ex-dividend date. So that's one of the things I do check before entering a pair. If it's ex-dividend date, I don't want to trade the pair. But if I'm entering the pair the day before ex-dividend date, or I'm having to hold over the ex-dividend date, I don't care. Ken's asking, with options, wouldn't you also have a problem matching the dollar risk? I'm not sure that that's really the problem. You'd have to probably trade larger. I guess that might be what you're saying, because options come in 100 lot. Your each option. Let's say that you're, keep it simple, let's say you're short a call and short a put on both sides of your pair. Both of those represent 100 shares each, right? So yeah, you're going to have to trade in larger size to have equal dollar amounts on each side. So that is an issue if you don't have that capital. Also, Ken's asking, do you have a TradeStation indicator? Again, the only indicator I have at the moment is NinjaTrader, but I'm certain over time, if the service is popular and there's requests, we can add the indicator to other platforms. All right. Cole's saying that trying to get the videos and sign up for the service, can't get it to work. Is my server down? So let me try to find out. So you should be able to just go to consistentoptionsincome.com, and the free pairs trading course, you just have to sign up for the free videos. So just click the button for free videos, fill out that form, and you should get an email with a link to all the free videos, which there's free videos there for my options course, there's free videos for smart levels, and there's a whole pairs trading course for free there. So it looks like it's coming up for me. Let me go to the actual videos page and check it for you. Yep, it's coming up. So I'm not sure. If you still continue to have problems, send me an email. We can work through it. It looks like it's coming up, but you just need to fill out the free videos form, and you'll get an email with a link to the free videos. But let me know if you continue to have problems. Okay, Terry's asking, can this trading be done in an IRA? And the short answer for that is no. You need to short stock, and you can't do that in an IRA. So that is one of the downsides. If the Department of Labor prevents people from trading options in your IRAs, I'm thinking a lot of people are going to take their 10% penalty and just get out of those stupid IRAs. I think the government needs to stop protecting us from ourselves. You know, things like the pattern day trading rule and stuff like that just limits what people can do with their own money. It doesn't make a lot of sense. I think their main concern is that people aren't being taken advantage of by money managers. So hopefully, longer term, they'll focus on that and leave independent traders alone. So Ron's asking, what is the expectancy of your pairs trading? Do you calculate the SQN that Van Tharp has popularized? And if so, what is it, please? So I use an expectancy calculation, but I do that at a stage in the curation process where I found the pairs, they're in the right businesses, they're co-integrated. Now let's see how they traded together over the last year. And I look through those and I use a calculation to make sure that each of those pairs has a positive expectancy. If they don't, I just don't include them in the list. But I don't have an overall number for you for the trades, right, going forward. That's just a filter I use to decide which pairs to include. So I don't have a number for you there. Rich is asking, are biotechs good candidates? And the short answer to that is no. You know, someone comes out with a cancer drug tomorrow, no matter how closely the two biotechs you may be trading in a pair are, one of them comes out with the cancer drug before the other one, your pair's totally skewed. Or they get FDA approval. So we just, that's a kind of risk we just don't need. Also, another thing we don't include are ADRs, which are foreign stocks. These days where the dollar's, all over the place, there's some currency risk that seeps in. These are the kind of risks we just don't need in a pair. So we eliminate those. We also eliminate like things like oil exploration. So there are some stocks that we know historically may be correlated or co-integrated, but we just don't want to trade them because of the extra risk. But most of the time, you know, stocks that behave poorly like that, they're just going to fail in the co-integration or the business model. So there are some industries that we just say we're not going to bother with. Mike's saying it seems this would do well in earnings and higher volatility, so just go right through the events, in my opinion. Yes, that's exactly the way I feel about it. You know, you're going to get some movement, and hopefully the pair that you have, the other side of your pair, is going to have sympathetic movement as well. So, you know, sometimes you're going to wish you hadn't held a stock through earnings, and sometimes you're going to be, you know, tickled pink that you did. So, you know, and it's a hedged trade. So, you know, if you were a long-term holder of like, you know, Twitter or something like that, and then they had earnings coming up, you know, you might put a collar on the trade, right? If you're really worried about it. And we're kind of doing something similar. We have a hedge, right? We have another side of our pair that's kind of taking on that risk. So I prefer to have the opportunities through earnings season because, like you said, volatility does increase. That just means stocks move more during earnings season, and I want to be able to participate in that. It's worth the extra risk, and I feel like the extra risk is balanced by the trades where you know, the earnings go my way. All right, thanks, Herbie. All right, thanks, Terry. Appreciate it. Ron's asking, is your administration for picking the pairs done in NinjaTrader? No, it's all custom software. So a lot of the curation of the pairs, in other words, making sure that pairs that enter my pairs list are good, sound pairs, a lot of that's custom automated software. And then in terms of like the opportunities, that's all custom software. It's just took a long time to develop, and it runs every day, and you know, it's been running actually for a couple of years now, so it's pretty sound. I think all the bugs are worked out of it. You know, I had to put a lot of refinements over the last 2 years, so it was, you know, it would work for, you know, public consumption, but I've been running it for my own purposes for a couple of years, so a lot of the bugs have been worked out early on, and it's definitely not running in NinjaTrader. The only reason I have NinjaTrader is just so when people get the signal, if the signal's stale, let's say they got a signal, you know, at 10 a.m. came through on Twitter, but they're at like, you know, their lunch hour or whatever trying to manage their trades, they have some place to go and look and say, hey, is this signal that came through at 10 still available? You know, is it still viable? And if the prices on both of the shares are still good, the indicator should show that, and so you can still take the trade. So Salim is asking, you had told me that the expected profit per trade is 1%, meaning if I had $1,000 allocated to each side, my expected profit would be $20. Is that right? Otherwise, that would. So it's basically 0.1%, right? So if you're trading $1,000 on each side, so you're allocating $20,000 to the trade. We're saying that your expected profit should be so if you take 0.001 times 20,000, it should be $20, which is correct. So trading in that size, $20 would be the average return for the pool of trades that you're picking from. Okay, Ron's asking, do I understand it's 0.1% per pair trade or per side of the pair? So the way I was doing it, I don't think it makes a difference, right? If you make 0.1% on each side of your pair and you have equal dollar amounts on each side of your pair, it's going to be the same number. But yeah, I mean, the way I was doing it was saying, okay, I've allocated $20,000 to this pair. The return of $195 is 0.1%, but that $195 return would be for the whole pair, both sides, because we open the pair together and we close it together. We're not trying to leg in or leg out. John's asking, how long have you been trading this yourself with real money? It's been about 3 years. I was using some other software and when I first started, I was using some other software that was using more of a spreading technique for finding pairs, and I was getting myself caught in these like pairs that I couldn't get out of. You know, they were going against me, and I had no way to get out of them that made sense. So I just started looking for a better mousetrap, and I just decided, hey, if I'm going to do this, I got to write my own software, and because there was no way for me to really, I was leveraging someone else's software. There's no way I could really backtest and try out different ideas. I thought there had to be a better way, so I tried lots of different things. And actually, one of the things that I found that's very common out there is people scaling in and scaling out of trades. You know, people do this in futures contract. They'll say, well, I'll put two trades on, 2 units on. Maybe I'm buying 2 contracts of a futures contract. And then what I'll do is, as soon as I get to break even, I'll exit one of the contracts. And so what people do that way is what they do is they increase their losses. When their losses happen, they take much bigger losses. And when their profits come around, it's hard for those profits on one contract to make up for the bad scenario. So unless you have a really high winning ratio, it just doesn't make any sense to me. It never did. And so people did that with pairs as well. What they do is they say, hey, these stocks have deviated. It's a good opportunity. They're spreading, if you will. And so now the trade has gone against me. And if they were, it was a good trade when they spread it a little bit. Now if they're spreading a lot, it's got to be even better trade, right? And then it spreads some more, and they keep adding to this losing position. So their losing positions can get really big, and their winners are kept really small. So that's one of the things I was able to sort of prove out to myself, that adding to a losing trade essentially wasn't a good idea, and these the spreading trends were worth avoiding, and I came up with a different way to calculate my entry signals so that the deviation and the return to the mean could be more accurately found, so that we're not endlessly sitting in a losing trade. Rich is asking, would smart levels help with pairs trading? I really don't think so. Creating the smart levels is a kind of a manual process, and the number of pairs that I'm trading, there's just no way I could do smart levels every day on every stock that I'm trading. I think that's much more for a focused trading approach. If you're focused on a single futures contract, or in the case of the option strategy that I teach, you're focused on a the RUT, just a single options index, cash index like that. It makes a lot more sense. But we're doing lots of different pairs, and to be honest, I'm not really that concerned that my trading signal is that accurate, right? Because I have a lot of confidence. 90% of my faith in the pairs trading isn't the signals I'm taking or the trades I'm taking. It's the curation of that pairs list. I know that, I have a lot of confidence that once I put this trade on, those 2 stocks are going to travel in a very similar way moving forward, right? And so I'm not that concerned about the timing of my entries into that pair. I know that there's going to be profit opportunities moving forward because I know those two stocks will trade in a similar way. So you're trying to refine the entry point beyond like avoiding the sort of spreading phenomena. It's just not that important to me. I'm just going to sort of mechanically put these things on and spend my time and effort curating the pairs and making sure I'm trading the best pairs. What data source do you use for your stock chart and price data? IQ Feed, question mark? Yes. So I use IQ Feed. That's for my proprietary software and also for NinjaTrader. Although I have a Kinetic account, I primarily use IQ Feed with NinjaTrader as well. How many, John's asking, how many trades will it spit out per day? You know, right after the sort of meltdown in the markets a few weeks ago, I was only getting like somewhere around 12 trades a day, and which is kind of low. So I would say on average it's much more closer to like 30, between 30 and 40 a day. So there's plenty of opportunities. They're all good, you know. Some people have asked me in the past, well, wouldn't it be better if you did fewer trades and they were better statistically? Well, the trades that I end up putting out, the pairs that I have, they're all statistically the same as far as I'm concerned. So there's just lots of opportunities in pairs trading. So you don't have to take them all, but I think it's reassuring when you're picking trades and you see all these closing orders come by with profits that you're picking from a really good pool of opportunities. So I kind of like seeing all the opportunities. I don't really feel like I need to filter it down to a smaller number. That way, any time of the day too. In the middle of the day, obviously, it's kind of the doldrums a lot with the market, but it's more likely if you have a certain time of day where you can trade that there'll be trades available for you. The more trades that are coming through, the more likely it is when you decide you want to trade, there's something there waiting for you to trade. Steve's asking, what software language did you use in writing my proprietary software? So yeah, it's a fellow geek out there, Steve. Hope you're doing well. Yeah, it's written in C# and .NET. So I know that probably doesn't mean much to most of the people listening, but it is a Microsoft C# application. So it's pretty stable. It works really well. And it's using SQL Server as the back end. So it's a pretty enterprise-ready application. John's asking, do you actually take all trades, or is it humanly impossible to do 30 average per day? I would say, first of all, I don't take all trades, and I think it, generally speaking, is humanly impossible to do that many trades a day and keep track of them. So, I take basically what I can handle on any given day. It may change from day to day, right? And then the conversation naturally sort of flows to, well, why don't you create some automation so you can submit these orders in an automated way, and that way you can take all the trades and you get maximum exposure. There's two considerations. The first one is, like, if I took all the trades, I'd have to trade them a lot smaller, right? Because you don't know where the limit is. At some point you're going to run out of capital, right? But also I still don't think it's necessary. I think if you're keeping 10 to 20, I tend to be much more locked around 20 trades, open trades at any given time. But if you're somewhere between 10 and 20, you're definitely picking enough that you're getting a good sampling from the pool of opportunities. And if you were to trade them all, you're not probably getting that much advantage. but it's just personal preference. If you're really into it and you want to spend a lot of time in it, there's opportunities there. If not, you know, and also if you go on vacation and stuff, most of your trades are going to close out fast. So it's pretty easy to come in and out of if you want. Okay, John, thanks a lot. I appreciate you attending. Okay, Ron's asking, so we won't be placing exits at the time we enter. We'll be waiting for the indicator you tweet to exit. For the most part, that's correct. However, if you wanted to, the problem is with exit orders or placing conditional orders is that you could put a conditional order on one side of your pair, one stock, and you get filled on that, but then the other side of the pair really isn't ready, right? So you're in a loss. So I'm thinking, somewhere down the road, this industry will evolve, and you'll be able to, when you're trading options, you can say, hey, I want to buy this option, I want to sell this option, right? And you can put an order in, and you say, I want to buy this one and sell this one at this particular price for both of them, right? You get to put a price for two different things you're trading. Whereas when you're trading two different stocks, you can't do that today. It would be really nice if the brokers and the exchanges evolved to the point where we could trade, Pepsi and Coke as a pair, and I can put in a single price to get filled on that pair. Maybe I'm going long Coke and short Pepsi, and I could get filled at a single price for the pair. However, we can't do that today. So until we can do that, I don't really see how putting conditional exit orders on would work very well with pairs. I mean, once the pair is sort of in a profit zone, you could say, hey, if either one of them comes up a little bit more, I'm willing to get out. But generally speaking, I'm not really looking at the prices of the shares to exit a trade. I'm looking at their relationship and that they return to some sort of mean relationship. That's usually my signal to get out. And if it gets to the mean, I don't do it a lot, but let's say that I have two stocks and I'm looking at the charts and it's returned to a mean. It's time to exit the pair, but because of the chart patterns, I think that there was some momentum in a particular direction, because a lot of times you'll get that reversion of the mean when there's all of a sudden a move happening, right? I might want to wait for that move to mature a little bit before I exit the pair, because I don't necessarily know whether I'm going to profit or loss, but if there's some momentum going a particular way and it's causing me to come back towards that mean, maybe I give it a little time, and maybe I can turn a loss into a profit, or I can turn a small profit into a larger profit. So I'm not really necessarily panicked to exit exactly when I get a signal. Also, one thing to note in terms of the exits is that, and it's true of the entries as well, you want to always use limit orders, and sometimes with conditional orders, you're using market orders. But because we're targeting such a small potential profit, we need to really manage our trades entering and exit. We want to use limit orders. We want to find the market in between the bid and ask. Maybe want to do a cancel and replace a few times to make sure we're getting the best possible fill on our short leg, which we enter first. And then we're going to want to work that long trade as well. We don't just want to, because we're filled on the short, go ahead and put in a market order for the long. We want to work the order, put in a limit at a really good price. If we're not getting filled, just do a cancel and replace until we get filled. So you don't want to give up the nickels and dimes on your execution. So over time, you want to get pretty good at doing that, because that's going to add up over time. Okay, I don't see any more questions. I'll give it a couple more minutes. If you want to enter a question, you can do it now. I'll give it just a minute. All right, I don't see any questions coming through. So thanks, everyone. I really appreciate you attending today. Again, my email is on the screen there. And let me know if you have any questions. I usually answer all my emails right after webinar. I'm usually swamped a bit, but I know it's hard to think of all your questions at once, so send me an email if you have any other questions. Okay, Ron. Ron's happy that I didn't use Java to write my application. There's a lot of geeks out there. All right, thanks, Ron. All right, thanks, Ben. Take care. Okay, Stacy. All right, thanks, Rajesh. Take care. Bye-bye.